We'll go ahead and get started. Welcome, everyone. So glad to see all of you on here. And my partner Nancy and I are so excited to talk to you today about having a successful year-end close and being audit ready. And just a little bit about me. I'm Heather Johnson. I am an accounting and advisory partner with Han Group and also a recovering auditor. So I see both sides. And if you're new to Han Group, welcome. We are a public accounting firm that's solely focused on nonprofits. That's our mission and our passion. And I know most of you share that same feeling. So we're so happy to see you here today. And I have this QR code on the screen. If anybody wants to click it and join our nonprofit community, we'd love to have you. As part of that, we send newsletters and do these webinars and roundtables. And we've really been bringing people together to discuss everything that's interesting and important for nonprofits, especially with an accounting side. I'd also like to give a special shout out to NICON, the New York Council of Nonprofits. And we're thrilled to see so many members joining us today. And we love supporting the great work that they do. So before we get started, I have a couple housekeeping topics. Just first, please participate. We'd love to see it. Feel free to join in the chat, ask questions. Some of you sent in questions in advance when you registered. Thank you so much for doing that. We'll be sure to answer those questions throughout the presentation. If there's anything that we don't get to, we invite you to message us, reach out to us, and we'd be happy to continue the conversation. And if there are any accountants, CPEs on the presentation today, this does qualify for continuing professional education. It'll be 1 credit. And in order to get that, you'll need to answer 3 polling questions. We promise that they won't be hard. And also answer the survey at the end. And even if you're not an accountant, still feel free to, or if you don't need the CPE credit, please feel free to still participate with the polling questions and the survey. Okay, so I think with that, we'll get started. Like I said, I pretty much introduced myself already. So I love doing accounting and advisory services for nonprofits. I've been doing it for over 25 years. And in addition to that, I facilitate a lot of these webinars and roundtables where we talk about emerging issues with nonprofits. So with that, I'd love to introduce my partner in crime, Nancy.
Thanks, Heather. We're both Johnsons, ironically, but not necessarily related. We are fabulous partners who work collaboratively together. We both have so much passion to helping clients, helping not-for-profits. We're so excited to talk to you today to give you some hints, tips, checklists. So my background, certainly, I stopped counting at 30 years, so 30 years plus, but I have always spent my entire career as an auditor. So as Heather said, she's recovering. I love auditing, love everything about it, love helping you. And really the key word is we want this to be a pain-free audit. So we really want to give you some tips and tricks and try to really help you get ready so that we want to collaborate with you as the auditors. And certainly as Heather being the accountant, we understand fully that collaboration is key. One of the jokes this morning was it takes a village to get through the audit. So we are ready to dive right in. So I think we have a quick polling question to get you started. And this
Yeah,
is,
so yeah, now that you guys know about us, we would love to hear about you too, right?
yep. So we'll go ahead and give you a minute to get started with that. So certainly, all right. So
And just
thank
a little
you.
bit of background, we actually created this program because we were talking with Nikon and they said, oh, they get a lot of questions that come in from people who are just doing their first audit or first couple audits. So we said, oh, we can bring our experience to this. Okay, perfect. So I see that we have some people that have a couple audits, some that have not been audited yet but are planning, and then several who have done it for many years. So those of you especially who've done it for many years, feel free to jump in and add any input if you'd like.
All right.
All right.
Okay, so we're basically we're trying to get you ready to close with confidence. As I mentioned, we want this to be a pain-free process, very collaborative. So what we're going to be discussing today is going to be, we're going to, again, we mentioned like going through, if you want to go to the next slide, Heather, we'll be definitely going through our checklist. We'll be going through the timeline. Certainly, audit what the auditors are expecting. Sometimes you're kind of like, well, I don't even know what the auditors want. So we want to make sure we cover that as well. And then certainly we've got day one readiness. We're going to talk about common adjustments. That's certainly, we love to, have a successful audit with no adjustments. So we're going to give you some tips and tricks on figuring out how to, some of the common ones that we see. We kind of created a list of very common AJs to help you avoid those.
And Nancy, I will jump in. We already have a couple
Yeah.
questions, so something that I
Oh,
should have answered. Someone asked if there will be slides to download. Yes, and this session is being recorded. So within a day or two, the session recording and the presentation will be emailed out to all of you. It'll also be on our LinkedIn and our YouTube channel as well. So don't worry, you will get it. And then a couple people mentioned that they are executive directors and looking to glean information, which is great. We plan to talk about that. And one of the questions we already got was kind of, if you have a bookkeeper and you're an executive director, who's responsible for what? And we'll definitely get to that too. All right. So Nancy, I think you were probably in the middle of this, talking about
yeah.
the objectives.
Yep. I think I covered it. Again, feel free to ask questions as we go along. Put them in their chat. We're going to be monitoring the chat. We're trying to save some time at the end to answer questions too. All right, back to you,
Great.
Heather.
Great. So I'm going to talk from the accounting side. With my role, we work with our nonprofit clients, and some of them we do monthly accounting for, some we just do year end, some we come in for just special projects, but it's all really the same. When we're closing a month or closing a year end period, we're always trying to make it pretty much audit ready. And that's what I recommend for any nonprofit, any organization that we work with. Get it as good as you can. This really is true when you're having board meetings, when you're sending out information to donors. You don't want to be going through the year and sending subpar information and then at year end having, a bunch of adjustments or truing up the books. So whenever you're able, try to have these monthly processes in place. And I'll say when we start our year end close, first thing we're going to do, we're going to take that trial balance and we're going to go through all of the assets, the liabilities, the net assets. We're going to go ahead and make sure that we have reconciliations for those. And as Nancy likes to point out, a reconciliation isn't just the schedule, but it's actually making sure that it ties to the trial balance too, doing that extra step. And also really looking at the unusual activity. So I've gone into certain clients where we've gone in just to clean up the books, and we'll see that reconciliations have been done, but they may have a lot of old outstanding transactions on them. And I would say that investigating those types of transactions is really a part of the reconciliation process. So if a team member gives me a reconciliation and I'm reviewing it and it has a bunch of unusual activity, outstanding activity, I would say that reconciliation is not complete and you should be investigating it. So when we're talking about bank accounts, old outstanding checks, deposits in transit, obviously those should not be older than, a couple days. Even your accounts receivable, somebody asked a question about what we should be doing with accounts receivable. And my advice to you is stay on top of it. The older your receivable gets, the harder it is to collect. And, there's your accounts receivable, which is for goods or services, also your contributions receivable. So you want to make sure that you're keeping in touch with those donors. You know when that money is expected to come in and that you're reaching out to them if you haven't gotten it when you expected to. What I've found in a lot of organizations, especially with contributions, if they have it, maybe a separate grants department, that we'll have a receivable on the books from a donor and we haven't gotten the money yet. And then when we talk to the grants department, we find out, oh, they had to send in a final report. But, the executive director may not be aware of that and may be thinking we're getting the money any day. But now that we've investigated that reconciling item, we realize, oh no, there's actually more work to be done. Also, credit cards. I hope everybody is reconciling their credit cards, making sure that support is attached, that you're looking for any fraudulent activity. This is an area of risk, and we're seeing it more and more, um, where just people are using credit cards, not turning in receipts. There could be some question costs. If you have federal money, I'm sure you know that that's really an even bigger issue. Even if it's a legitimate charge, you won't get reimbursed if you don't have the receipts to go with it. And then the big area for this year, I would say, is really revenue recognition. It's not just this year, but revenue, especially nonprofit revenue recognition, is just getting more and more complex. And we're seeing a lot of it this year and last year, especially with last year, as we talked about navigating uncertainty and all the changes and federal funding and even foundations and corporations kind of putting a pause on funding. We've really been talking to nonprofits about diversifying revenue, getting new donors, and even possibly looking at different revenue streams. And so with that, there are a lot of different accounting implications with that. And so it's interesting. One of the questions that we got in advance was a question about AI tools. And the question said, um, how do you see AI assisting small organizations and remaining gap compliant? And I will say the answer to that, in my opinion, is AI is a good tool and it's getting better and better. And we're seeing a lot of the software programs start to incorporate AI with either coding transactions, maybe even reconciling accounts. And that's what it is. It's a tool, but it's still going to take management to go in and review it and make sure that it's been done correctly and that the different nuances have been captured in those reconciliations. And that
And
those,
Heather, that
yeah.
no, sorry, Heather, that brings up a good point too, because sometimes you can't rely too much on like AI, for instance, but the same thing happens if you're over relying on Bill.com or Divvy having these syncs. And then you realize, the auditors come in and they're like, well, wait, these aren't, they're not matching. Your credit card statement's not matching, or your Bill.com, like there's a match. So it like you might think that there's these automated tools out there and they're working, but it really does take one more step to verify that yes, actually they are syncing properly and every month Bill.com has been cleared out. Because we've had instances as an auditor, we come in and we're like, wait, why does Bill.com payable account that's supposed to zero out is not zeroing out? And like again, if you got some glitch months ago and you just weren't catching it, and then all of a sudden it becomes an audit issue. So those are some instances where you might think you've got the tools in place, but it really just takes that extra check, as you're going through this year and close, to just do one more official reconciliation to say, yes, it actually does work.
Yeah, that's a great point. Thanks, Nancy. And I'll say just to wrap this section up, the final thing really with year end is making sure that it's complete. Your numbers are complete, right? And that you have those accruals in. Some people like to close their books very fast after each month. We always recommend at year end that you leave your books open longer. Give those bills time to come in. And for any of those vendors, like lawyers are notoriously bad at sending in their bills in a timely fashion. reach out to them in advance and say, hey, we're approaching year end. Can you send us our December bill? Or, June bill if you're a June 30. Also, maybe consultants, if you know that you've been working on big projects, get those bills in, get the receivables in. And I know, Nancy, you said that you've seen people actually not reconcile or not accruing payroll too. That seems to be a bigger issue that's been coming up, right?
Yeah, because
So
again, sometimes it's just a matter of timing. If you're not a, you know, January 31st payroll and you're happening to close out on the 28th, you've got a couple of accruals. And then sometimes it's just a matter of your ADP might one year release the checks on the 31st. The next year they might have released it on the 3rd, causing that accrual. So it's just one of those things you just kind of got to watch each year that might change on you.
we have another good question that just came in asking about materiality. And I will say, I feel like accountants and auditors kind of fight over this topic. Auditors say that they own that word, materiality, and we accountants should be, reconciling to the penny, which, sure, in an ideal world. I will say the auditors are going to come up with the materiality with their calculations and their judgment. On the accounting side, though, we look at things like if we're talking about when to close your books, if we've closed your books and you're, a $10 million organization and a bill comes in for $100, we're probably not going to reopen the books to put it in that period because it is so small. And a lot of times what we'll do on the accounting side is we will actually create a list. We'll keep a list of all the bills that have come in after we close the books to say, here, we know that these bills belong in the prior year, but the dollar amount is so small that we didn't
Mhm.
do it. And we'll even just provide it to the auditors or have it ready in case they ask. That way the auditors know that we understand the rules of GAAP and that we are aware of what's happening, but we've made this judgment call. Do you have anything to add about that, Nancy?
No, you're absolutely correct. It can be twofold. Management can certainly set their own de minimis and then just advise the auditors, hey, we thought this $1,000 was de minimis. I've had clients reach out to me and say, hey, what do you think about this one little straggler? So, yeah, I think it's appropriate for management to set their own. And then the auditors are going to come in once they actually see what the year end numbers are. They might do their prelim numbers based on last year, but once they see the final trial balance, they'll set their own materiality, but we as auditors always set a de minimis as well. So then you've got, anything that's above that de minimis, the auditors are going to have that conversation with management at that point to decide, do we pass on it, not pass on it. So it comes down to judgment, and it comes down to documentation, as Heather mentioned. You might know about it and just to make a decision is my judgment call to pass on it. And then you just document what happened and why you're passing on it. And then everybody's in the same loop on it.
And Nancy, I think that you brought up such a great question too about just reaching out to the auditors. And we do that too, even though, I mean, we're CPAs, we're accountants, I've been an auditor. When I'm working on a client's financials, if they have a grant that comes in that, let's say, it has lots of milestones, it looks like it could be conditional, maybe it's really tricky. I will, of course, make my own judgment, but I will still reach out to the auditor beforehand and say,
Mhm.
just so you know, here's what I'm planning to do. Do you agree with this, or is there any additional information that you need in order to feel comfortable with this? And if you do that before year end or before the audit, you're going to have a great relationship with that auditor because the auditor wants it to be just as
Yeah.
clean as you do, right, Nancy?
Yeah, and I would say most every auditor is willing to have those conversations before year end or before even the audit so that we can just go ahead and work out those accounting issues because we would love nothing more than for you to have a clean audit with no adjustments. So absolutely reach out to your auditor as you're getting ready to close. You haven't turned over the final trial balance. Go ahead and have those conversations on those tricky grants or DAFs or, things that have come in that are unusual.
And I think that, Nancy, don't you feel like if someone reached out to you, that would actually reflect positively on them?
Oh,
Be like, oh, this
absolutely.
is great, not, yeah, yeah.
Yeah.
Okay, well, great. So I think as we go in, let's do another polling question. And this polling question is going to say, how confident are you in your year-end close process today? What do you think, Nancy? What do you think the majority will say?
Probably down the middle of the road. Some people
Yeah,
are really comfortable, and other people are kind of like, oh, I dread this. Like, I don't know where to start. So,
yeah. And I think that, anyone working on the accounting side or executive side, even if everything's perfect, you're probably just going to still feel nervous, right? Even until the end of the audit, until it's done, just because you care so much.
yep, yep.
So I think you're right. It looks like most people are somewhat confident, um, and some are not at all. And it is stressful. It's one more thing to do, especially when you already have a an accounting team that is probably stretched pretty thin. And we all know that there's even a shortage in being able to find accounting talent a lot of times, which is why sometimes we come in and just do that special close. But yeah, it can be good. So hopefully today's webinar will help everybody get a little bit more comfortable. Just a few more things. So again, I really feel like revenue, if you have to pick one item, and Nancy can correct me if wrong, but I would say focus on the revenue. Make sure you've read those grants and contributions. I think that it's especially tricky with a lot of donors giving DAFs. We're seeing more and more of that this year, and that can change the accounting treatment. Also, unfortunately, we had seen a big trend of money coming in unrestricted, but I think this year in 2025, we saw more coming in as restricted. And I think that might continue for a while, and even more with milestones. And that could actually make the accounting for a grant conditional. So those are the ones that you really want to look at, read through. And if you have doubt about what your donor intent was, if you have a good relationship with that donor, you can feel free to reach out and say, I just would like to clarify, are you considering this unconditional or are you considering this restricted? Um, okay, a quick mention about fixed assets. I like to mention fixed assets because I remember when I first started auditing, we would have the capitalization policy at like $500. And now, there isn't a set amount that this is what it has to be. It's normally a range, but the IRS has said that they're really comfortable with 2,500 to 5,000. So that's normally what we see and what we recommend. So every once in a while, when I look at a client's financials and I see that 500 or 1,000, I just feel like, oh, why are you doing this? Why are you putting this extra work on yourself? So that's one thing that I would look at, and then make sure that you're following that capitalization policy. Again, for your pledges and commitments, like we talked about, stay in touch with your donors, know when you're supposed to get that money coming in. And if you haven't, reach out, make sure that it's still collectible. You will need to book, you'll need to test it for collectability. Also, possibly a discount if it's a multiple year contribution. And then, looking at your net assets and your revenue always go hand in hand, right? And just making sure that you have a good handle on your net assets without donor restriction versus your net assets with donor restriction.
And Heather, certainly that as you talked about the pledge as receivable and you've got multi-year, this is a good chance to say, hey, is that present value discount even material? Because it might be, yeah, it's only $1 million is coming in the next 2 years, but if I look at my overall financial statements, it's not material. So this is a good judgment call to identify to the auditors of like, hey, I know that I should have discounted it for a multi-year, but it's not material, so we're going to pass on it. So
Yeah.
that's a great example where you can blend that in and go ahead and make that decision as you're closing out your year end. but we
Perfect.
but we certainly, we take an audit risk approach to say, hey, we're going to do the riskier sections first. Revenue is always going to be your high risk, no matter what not-for-profit size you are, small, large. So we think, going into year-end close, focus on that as well. Just put more of your effort into really honing in on those receivables and revenue recognition, and then the rest really falls into place.
And just quickly, I see Melinda did ask a question about what do I mean by donor milestones. So, not all grants have them or contribution letters have them. We're just seeing more and more come in lately. And what that means is there'll normally in the letter be they're normally called specifically milestones, and they'll say, here's this money. With this money, we expect you to to write 3 papers or to hold 4 meetings, or it'll be very specific things, or, we expect you to feed 100 people. And if you don't do that, if you don't feed the 100 people, then you have to return the money. So that's what it means to be a milestone that would impact how we account for that revenue. If it's something like every donor grant, almost all of them at the end say, "Oh, send us a final report." That doesn't count. That's a little administrative thing. That's fine. It's just when it's those specific numbers. All right, Nancy, so let's get in. So now,
Yeah.
because of this talk, everybody has a perfectly closed set of books.
Right.
So now what do we expect from the audit?
Yeah, so we've sort of broken down. I would say most every audit's going to definitely have the minimum of three, where you've got planning, you've got field work, you've got wrap up. But we think, the most important really is going to be your planning. And this is where, you're leading into December. Have those pre-audit conversations. I've got another slide following this to really talk about what do you talk about. But you really just gives you a perspective of like where you are in your process. So if you're a December in, you might have already started talking to your auditors in November, January, knowing that your audit's going to come up. Interim work, this is a great time to get those confirmations out the door. It's really, your auditors might come in and do the walkthrough to make sure they really understand internal controls, so they even know how to pick samples. Can they rely on internal controls? That's really what interim work is just kind of get their feet wet in the door, but they're not waiting, they're not really relying on those final numbers. The next phase is certainly your year-end close. That's where your accountants, you've now gotten everything, all your reconciliations, you're ready to start rolling, getting all the things uploaded to the portal prior to actual field work. So then when we talk about, the auditors say, field work, well, it used to be the days where, our team would just show up on your doorstep, plop in your conference room for a week or two. Now it's a little bit different. Obviously, there's so much behind the scenes going on in the virtual world. Field work tends to be, I would say 98% of my clients are still virtual. It works out great for both sides. It's a lot more efficient in a way, but at the same time, it does create a little bit of inefficiency because you get a lot of back and forth kind of questions. But certainly, give yourself, as Heather mentioned, give yourself, enough time after year end. So whether it's 4 weeks, 6 weeks, so that if you're a December year end, you might not be starting your audit till like the end of January. Some organizations like to wait till springtime, so early March. It's really just depends on, your organization, when your board meetings are. What I like to do with my clients is work backwards, so that if I know when your board meeting is, then I'm going to work backwards into when is field work. I'm going to see how much I can upload into my planning phase to make sure that the confirmations come in the door. Especially investment firms are now being really difficult. Some are saying you got to go through confirmations.com. Some are saying, well, we can't give it to you. It's just, investments are kind of becoming a little bit of a trick getting confirmations lately. But certainly, once you get through field work, you've got a lot of back and forth. Communication is by far the most important tool of this field work. It's just, having that open lines of communication. Who's talking to who? Which portal are you using? Do you want to use email as well as the portal? But what we're finding that works out super well during field work is just have that weekly call in person on Zoom, where you can just really go through the conversations face to face. really, answer a lot of the questions rather than the whole back and forth via email or Link. So we really love to have those one-on-one conversations with the clients during the field work.
And
And then,
can I
yeah.
add, Nancy? I just want to say that I think that that fieldwork timing is so important. And because that really is when your auditors are going to be dedicated to doing that work. So if you're an organization and, the auditors have made requests and you delay giving it to them, if you're like, oh, I'm not going to get that to you in a couple weeks, just remember, normally it's going to be hard to get that dedicated attention back. And they're going to be trying to piecemeal it while they're probably on another audit. So it's so important that you try to be ready and have everything in that week, and to tell your staff to say, don't go on vacation, this week of field work. Please be available and be as responsive as possible.
Yeah, and we certainly think that the best approach is to get these dates in writing during your planning meeting, your pre-audit meeting. Get everything in dates, the specific kind of weeks that you're going to dedicate, so that, like Heather mentioned, everybody's on site available for questions, so we can really just hone in on concentrating on you as a client, get your audit done, and then that leads you well into wrap up, that it makes it a lot easier. We can finish up our subsequent events. We've got the draft financial statements we'll go over with you, certainly any adjustments during field work as we're wrapping things up. But certainly having this timeline in writing well established at the beginning kind of helps guide all of us through. And I'm the first one to say I love having a deadline. If I know when your board meeting is, I'm going to be that little hamster on a wheel going, hey, no, we're going to make sure we meet your deadline. We want to make sure we're committed to getting your deliverables to you. If you have absolute hard deadline, you want to get that 990 out the door May 15th, just keep in mind that that kind of backs you up to say, hey, I got to get that audit draft ready 3 weeks before so the tax team has enough time. So it's really having that two-way conversation with, certainly you as a not-for-profit and the auditors to say, hey, where are we? Are we staying on timeline? Um, so going into the next, as I mentioned, planning is absolutely one of the keys to a successful audit. It's just having that, I call it my pre-audit meeting when I have with my clients, of just having that conversation. That my number one thing is, Sally, same as last year, is never, ever, ever the true story. My clients are like, oh, okay, well, nothing changed, the same. And then by the time I get through 50 questions with them during it, I'm like, well, something changed. So there's always some little thing that may have changed. You might have had, either management turnover, you might have had a new line of credit, even that would just trigger a confirmation for us. So again, it's just having that conversation where you can talk about your timeline, get it in writing. You can certainly talk about scope. We've got caught on a couple of scenarios where we got through the whole audit, and then all of a sudden we thought that the entities were separate, affiliate sister companies, and all of a sudden we go, wait, you just now gave us the board list, and they're the same board, and now you've got a consolidation. Flip the whole audited financial statement. That we should have figured that out well at the beginning. So there's again a scope conversation of related parties, things like that we really want to talk about in terms of how our approach is, what your financial statements. Also, a good conversation to have is some clients love single year financial statements, some love full comparative, some love just single year, but just comparative totals, which means the footnotes are singular. Really having that conversation up front is, let's talk about what the year-end deliverables look like. What do you want to present to your board? What's important to your donors? When do your donors need to see it? If you've got charitable registrations, you want to get out the door in the summer. That's when you've got the most time to get those charitable registrations. It's having your audit ready for those charitable registrations to get attached. So it's really having these conversations with your auditors to figure out, again, scope, approach. Certainly changes. Again, do not say it's same as last year. We're going to deep dive, figure out what really changed.
And Nancy, I'm really happy to hear you talk about the financials. And that's something that I hope everybody realizes those financials are yours. They are the
Mhm.
organization's financials. The auditors are coming in to test them, but they're yours. So if you
Mhm.
see that the auditors, if they've, prepared the financials and, changed the groupings or done things in a different way that you weren't looking to have, then go back and have that conversation with the auditors. And maybe the auditors just need your groupings too. So it could just be
Mhm.
a communication issue, but you should get what you want for sure.
Yeah,
And
and a lot of
oh,
go
go
ahead.
on.
I was going to say, a lot of times it really does help to have that grouping conversation. Look at the trial balance, especially if you have a lot of new accounts, if you've got a new program, you've got new expenditures, natural expenditures. Just have that conversation with the auditors of like, oh, let's decide exactly at the beginning where do those new items really get coded? Because that really does make it helpful for both you and the auditors. So you're on the same page in what the final deliverable is going to look like.
Great. Lexi, I think now's a good time for the next polling question. This is going to talk about how your organization prepares for an audit. Hopefully, you're doing A, which we just talked about, having that meeting.
Mhm.
I know a lot of times, it ends up being B, where you talk and prepare once you get that PBC list. And the PBC list is prepared by client. So that's the list of what the auditors give you to say, here's what we need you to do. This leads into a question actually that we got, who it was from somebody who said, I'm an executive director of a small nonprofit. I use a part-time bookkeeper. What's my responsibility? What's their responsibility? And I will say when I go in and I help clients get ready for audit, what I'll do normally is I'll pull up that PBC list with management and I'll say, I'm able to do these items on the PBC list. Of course, I can do these schedules. Um, but what do you want? So it's still up to management to say, okay, yes, my accountant should prepare these schedules, but then, management, do you want the accountant to upload those schedules directly into SureLink or whatever
Mhm.
program the auditor is using? Do you want to review them first? And just remember, for management, you're going to probably have more information than that accountant will have because you will have been privy to the board meetings, the strategic planning, all of that. And at the end of the day, you'll have to sign the management rep letter, right, Nancy?
Mhm.
So
Mhm.
you
Correct.
definitely can't just give it all to the bookkeeper. You're going to have to sign off on it at the end, right?
Yep. And certainly those of you that use SureLink, Han Group uses SureLink. It's a great tool, a great portal. But one of the benefits is that it actually will let you tag whoever's invited to SureLink. So each person can get tagged with, the executive director's in charge of minutes, the accountant's in charge of the bank rec. So you can really divvy that up ahead of time so that it's all transparent. You've got accountability into who's doing what, and then it really makes things move along a lot smoother to just have that conversation during the beginning to who's doing what.
Great. And I saw a few people did say that they were unsure of what that preparation should be. And so like we said, the auditors should give you a list of what they're looking for. And if they don't, just ask for it. That's
Mhm.
fine. They'll have it and just say, "Oh,
Yeah.
what do you want us to prepare?" And then find out from them too. Say, "When do you want it?" Most auditors that I work with want the information probably, 1 to 2 weeks ahead of time so that they can do their planning and make selections. And they'll give you a whole list of governance items that they'll need as well as financial items. And
Mm.
like I said before, when we're preparing the books, every month we're basically making them audit ready. I see Tammy on here said the same thing, so that's fantastic. And we want, before the audit starts, to have these couple things that are listed up here. Mainly, that trial balance that we told you about. We want to have all of our adjustments will have been in, our year-end adjustments. We will have closed it out. We'll know that we have those reconciliations done. We will have looked at those reconciliations to make sure there are no unusual, unexplained items on there. So then we'll be able to give the auditors our full general ledger detail with the trial balance. financial statements if they want. Some auditors want financials, some don't. And then have those supporting schedules ready, that you do those reconciliations on. And also, of course, your bank recs. So cash is king, right? So we want to make sure that you have all banking activity accounted for and no unusual transactions. There are also governance issues that you'll want to address. And if this is a first year audit with your auditors, you'll probably need to give them a lot of your normal first time things like your IRS determination letter, state registration documents, and so forth. Another thing, make sure to give them your leases. And if you're entering into a new lease, this year or next year or modifying your lease, be sure to give it to them. Even if you're saying, well, this is a 2025 audit and that's not happening until 2026, they need to know about it because it could be a subsequent event that they need to disclose. So just the more information you can give the auditor, the better. And remember, it's a collaborative relationship. It's not a gotcha. It's not an adversarial relationship. So just be upfront with what you have. Also, the board minutes, they'll need the board minutes. So if your board takes a while to get those minutes typed up, just be sure, even before year end, to say, hey, the auditors are going to need those. They're also going to need the subsequent minutes too. So if you have not read through the board minutes and you're reviewing the financials, you may want to take a look too to just make sure that everything mentioned in the board minutes is accurately reflected in the financial statements. And then we have a list here of all of your policies. These are just good policies to have. If you don't have them, I recommend that you do. These are what help build trust with a nonprofit and their donors. And on the 990 is going to ask you if you have a lot of these policies. So, and a lot of times, excuse me, the auditors will do your 990s. And finally, Nancy, I think you'll probably appreciate this, but if you've had a prior audit and you had prior audit adjustments, please make sure that they got booked. So that's
Yep.
the worst thing when the auditors come in and they say, wait a minute, our audit adjustments from last year weren't even booked. And then
Yep.
that can cause, concern about what's happened in the current year, right, Nancy?
Yeah, we always joke that the first thing we check is net assets to make sure it ties to your prior year audit.
Yes, yes.
Yeah.
All right. So, um, and then again, just finally, I feel like we've talked about this a good amount, but just remember the day one. So a lot of that stuff you can actually send to your auditors beforehand, uploading through SureLink or whatever way you're giving that information. And then you're going to also want to make sure that they understand your chart of accounts, your organizational chart. Make sure they have those significant contracts and agreements. Like Nancy said, they're looking at risk. So they're going to want to see those higher risk areas. And revenue is the risk area just because it's more and more complex. So just making sure that it's getting recorded correctly. Have all of those letters. For expenses, when I'm working with a client and they're getting audited, most of my clients use an online bill pay system like Bill.com or Ramp. And so normally we'll just give the auditors read-only access to that system so that they can go in and pull the bills that they want themselves. Unlike the old days when they would make selections and we'd go to the file cabinet and have to pull out all the bills. So that's what I recommend. I think that that works well on both sides. If you're not using online bill pay, then just make sure to have those vendor files ready so that you can pull bills. And then you're going to want to have your current year budget and your next year budget as well. That'll be important to take a look at, and your insurance policies and any related party agreements. All right, so
Yeah.
Nancy, what are you
Yeah.
really looking for here?
Yeah, so again, I think, certainly as we mentioned, accuracy, completeness, we want you to not have any audit adjustments. So the better you can go through, scrub your reconciliations, make sure your reconciliations actually tie to your trial balance. That's always helpful. Certainly gap compliance, we want to make sure you're recording pledges receivable. If you have a discount for multi-year, that relates to gap, certainly. Supporting documentation is certainly, as we mentioned, your PVC list prepared by client. That is going to be the key. Like, what supporting? Do you have bank statements? Do you have investment statements? One thing we are finding nowadays is we will ask a new client, we're like, oh, we'd like to send the confirmation. We're finding that every bank statement is now doing the XXX last four digits. So that's one of the conversations we're having during our pre-audit meeting to say, oh, well, we actually need the full account number to be able to do confirmations.com. Um, Internal control is really interesting because it's size based. Everybody has to have internal controls. Your auditors have an obligation to understand your internal controls. It's up to each auditor to how much reliance they're going to put on it. The more reliance we can have on internal controls operating effectively, then it reduces our substantive tests. If you're a really small organization, they might just say, yes, we understand internal controls, but we're not going to rely on it. It's easier for us. You've only got three major donors. We can test that quicker just looking at those agreements. So each audit is individual. Each audit client, they've got nuances to it. It's never the same audit twice. Even last year's audit might differ from this year's audit. And so it's helpful to have that conversation, helpful to have it documented as well, internal controls. And we talked about AI earlier. You can actually go to ChatGPT. It will help you create written policies that you can get a baseline and then tailor it to your organization. So you do have a written policy to document who's doing what internal controls do you have. Certainly compliance, single audit's a whole nother conversation. We won't really deep dive into that at all, but certainly compliance with restrictions. If you're, again, as Heather mentioned, you might have some grant agreements have restrictions on the program, the type of activities. You might have conditional restrictions where you can't even record that revenue because the conditions haven't been met yet. So as we're going through these grant agreements, it's very much we're trying to decide, is it unconditional? Is it conditional? Is it restricted? Is it unrestricted? So those are what your auditors are really looking for when they say, oh, I've got to test revenue recognition. So if you've got grants, if you've got memberships, for instance, they're looking for compliance with like membership period. Is it in the right accounting period? So those are certainly some of the areas that we really focus on. And again, as we mentioned, it is risk-based. So, if you've got a huge investment portfolio, that's going to rise to the level of looking at more so than if you've got, 300,000 in cash or something, and you've got a $10 million investment portfolio. That's going to drive where our time is being spent. Outside of, we're going to focus on revenue, receivables, net assets first. So we are going to certainly do that. And then again, risk areas is going to carry over into your footnotes, your financial statement disclosures. And that's why we talk about certainly related party transactions. If you've got affiliate organizations, if you've got other scenarios that you might have a board member providing services, any of those related party transactions are going to elevate the risk for your organization. We really want to make sure that we're capturing that early enough on in the audit to take care of it.
So, Lexi, let's go ahead and do our final polling question so everyone can get their CPE credit. And this is which area causes the most audit adjustments for your organization. And Nancy, I think revenue, don't you?
Absolutely.
Yeah.
And it's for multiple reasons because a lot of times, again, if you have an adjustment for revenue, it tends to be on the higher dollar side. So it rises the level of like, oh, do I have a material adjustment? Number one. And then again, we've talked about how complex these foundations and these donors are trying to make these agreements. Some foundations are great. They just rate out, say this is unrestricted money and call it a day. And then others are getting a lot more complex in having conditions or having restrictions and really honing in on, are you meeting your budget? We want, it's not just about reporting anymore. It used to be like, here's some money, give us a report, call it a day. We're just seeing a lot more complexities to if they've got multi-year, do they have to approve you before you can even get the second installment? So there's
Yes.
a lot of different nuances that we're seeing, a lot more complexities out there.
Also, I will caution people just to be careful if a DAF is involved. We got to be careful about an intent to give versus a promise to give because what we're seeing from some donors is I'm going to recommend that this staff give you money. So if that's the case, that's really just an intent to give. It's not even a promise. So we actually would not even record that as revenue. It's really nuanced. And I think that that's where we're having a lot of these conversations. And that's where I would absolutely bring that up with your auditors and say, hey, I'd love to run a few of these by you just to make sure that we're both on the same page.
Yeah. So yeah, so going into the next slide is basically, again, as we mentioned, we would love for everybody to have a nice clean audit, no adjustments. So really, we gave you, Heather and I are famous for our top 10 list. We love our top 10. Um, we were trying to figure out how many top tens we could get into the slide deck, but we cut it down. So this is just certainly an easy slide. You can just have the conversation with your accountants as you're, pre-audit to just say, hey, these are a couple things that, we'd like to make sure that we've captured before the auditors start. So I'm not going to go into each one of these. We're certainly, if you have any questions on that, we're always happy to help you. Just look at, certainly GAAP accountings on some of these, but certainly unpaid bills is always kind of a key. We like to try to avoid sometimes just we see what happens is that you'll put something in to a payable and then in essence we code it a prepaid and we're like no, that doesn't make sense to gross up your balance sheet. So a couple of things like that we've included as well. Just keep in mind certainly if you do have federal awards, that federal grant accounting revenue recognition is completely different than your unconditional grant agreements. So then that causes a little bit of confusion a lot of times as they said, oh, well, I got a $2 million federal award. I recorded it all up front because that's how I did my other grants. But no, it's a little bit different. It really is conditional. You're waiting till those expenditures happen. Um,
I will say too, I think one thing that helps to just kind of identify, do I feel like there might be a problem with any of our numbers, is to compare to last year. So if you say, oh yeah, we had about the same number of employees, maybe everyone got a 3 or 4% raise, then I would expect your salaries expense this year to be a little bit, 3 or 4% more probably. So if it's, significantly under last year, then that's
yeah.
probably a good clue that maybe you didn't accrue that last pay period. So just things like that, or if you see that, well, that's really the best example. But I think doing those comparisons can help you kind of pinpoint and say, okay, we may be missing an accrual here.
Yep. And that's why most of the times, your auditors will start with that pre-analytical where they are exactly doing that, where they're comparing this year's trial balance to last year's trial balance, looking for new accounts, looking for changes. So that really helps. So the
And
next,
Nancy,
yeah.
I'm sorry. I'm just gonna say, I see we only have about 5 minutes left. I feel like we've really have discussed all of these
Mhm.
topics already. So I want to make sure that we hit this last section because we got actually multiple questions from people about questions about liquidity and going concern. And we've been, like I said, we've been doing these webinars and roundtables for well over a year now with our nonprofits, especially with the uncertainty with the federal government and giving from foundations and corporations. And some organizations are choosing to diversify their revenue, which is great, going for different don't funders and also maybe even changing up their revenue streams, which is also, great. But that can be slow, right? So even though you know that you'll be in good shape in 2 years or 3 years, maybe it's a tough year right now. So if that's the case, your auditors are going to probably look at your numbers and to see if there is a going
Mhm.
concern issue. And we want to talk about what you should have prepared for that. So, Nancy.
Yeah, so certainly documentation is absolutely the key. And this is where we mentioned we talk about what's in your board minutes, because if your board itself is having a conversation to say the board is concerned about where you are in the next 6 months to a year, then that automatically raises a red flag. The auditors are going to know about it. They're going to have that conversation with you. And then it does come down to documentation. We usually say, if your approach is going to be going after new revenue streams, new fundraisers, new campaigns, show the auditors, oh, we've either hired a new marketing firm, or here these are some of the letters. Our board's now involved in helping us raise new funds. It's documenting how are you going to get more funds. Your second approach might be, I've got to cut expenses. Heather works with her clients all the time. I'm like, okay, well, here's our cash flow projection. Here's exactly which expenses we can cut without damaging our programs. So it's having that conversation, documenting to the auditors their cash flow projections, your financial statements leading into the following year, where there's expenses, like it doesn't make a difference, significantly on if I'm going to cut payroll, for instance, how's that going to impact the organization from a liquidity standpoint? It might be, simple as, I need to get a line of credit to help with the peaks and valleys. We see that all the time with not-for-profits. So it's, if you've got a line of credit that you're getting, say in 2026, again, that goes back to your disclosure. So these are the conversations that you want to document, making sure that you can provide the auditors, because most auditors will have to decide, do I actually have to change the audit opinion to highlight that going concern, or is it just possibly I need a management plans footnote? And if that's the case, again, that footnote needs to be audited, and then we have to go through the documentation process to understand and gather those information, such as the budgeting for next year, financial reports for next year. So
And I
again, I
will
think it's,
add,
yeah, go
yeah,
ahead.
yeah, I just wanted to add if you are thinking line of credit, obviously the best time to get it is when you don't need it, right?
Mm-hmm.
So, if you're
Yeah,
in good shape now, but you see things
yeah.
maybe slowing down in a year, try to apply for it now. If you've already passed that point, get a good working relationship with your banker, get have those conversations with your banker, or if you have a good investment balance, you could also talk to your investment person about borrowing against your investments as well if you don't want to have to liquefy. But lots of things to consider, and just be upright and honest with your auditor. Have those frank conversations. They know it, they see the numbers, so it's not a surprise.
Yeah,
And
yeah.
the more you talk to them, talk to it about, talk about it with them, I think the
Mhm.
better, right, Nancy?
Absolutely. Yeah, communication is always the key. Communication, documentation.
Yes.
Um, So we won't go really, we did one final slide just again as the auditors, as you're getting ready to wrap up. Again, management, as we mentioned before, is ultimately responsible for those deliverables, those draft financial statements. It's really key. But have those conversations with your auditors about, any management letter recommendations. We love it when, we have those conversations and then we can put together a management response if there's any findings, to just let the board know, like, hey, we've identified this. We are on top of it. We would love to fix it. This is what we're doing. We're actively responding to any comments so that the board feels comfortable that we won't have a repeat finding. So again, having that debrief with the auditor, absolutely. And then you go into the board presentation. We try to do PowerPoint presentations to make it a little easier to understand. Because again, if you've got 12, 15-page financial statements, it can be overwhelming. So we try to really make it easy for the board to understand. So we're going to see if there's any final questions. We've tried our best to go through questions that we got ahead of time. Are certainly, I see one question about how often the partner rotation. That is really a unique thing to not-for-profits. We see that, certainly if you've got a firm that's large enough that can rotate partners, that can be anywhere 5 to 7 years, but it's totally up to your board's comfort, on when that rotation. There's not an absolute standard. Sarbanes-Oxley on your for-profit clients are much differently, but the not-for-profit community has not set out any requirements. So each organization's a little bit differently. We tend to see 5 to 7 tend to be a norm, but certainly a partner rotation within the same firm really helps you. And even just trading out managers, seniors, that really helps you get a fresh set of eyes. So we're always happy when that happens, but certainly it's up to the board. The board makes those governance decisions. Yeah. Let's see what
And
other.
yeah, I see another question just asking about resources you can share to an org's audit committee. I think that that's a great question. Nancy and I actually just recently did a different webinar called Demystifying the Nonprofit Financial Statements. And, when you're working with a board or an audit committee, it's great to assess what their knowledge is, and do a level set. Go through, explain what the audit process is going to be, how it's going to work. Normally, your auditor should be able to go in and have that conversation with them. Of course, you're welcome to share this presentation too, or we're
Yeah.
happy to answer questions after this. But it's a pretty routine thing, don't you think, Nancy, where you go in and kind of explain what's going on?
Yeah, absolutely. And having that conversation with the audit committee. The AICPA does have an official book called the Audit Committee Toolkit. It goes through a lot of establishing an audit committee charter, what they're responsible for. And a lot of times it's just having those conversations with the audit committee. Some are more in tune and really want a deep dive. Others want to stay more high level. So again, it's having that comfort. We always love it when you do find a finance person that's willing to join your audit committee, help them understand it, but we try to certainly go through it and give as much information so that they can understand it. We always talk about revenue recognition. So it is certainly meeting the needs of your committee and what their level is and how to really explain these financial statements to them so that they understand it certainly is helpful. And we've done both pre-audit and post-audit meetings. Some of our clients have pre-audit meetings where we will go through the timeline and the engagement letter and have those conversations, and then some just have post-audit. So each
And
client's a
just
little
one
different.
Yeah, I know we're at time. Just one final question about rotating audit firms. There's no requirement for nonprofits to rotate firms. So I know when Sarbanes-Oxley came out a long time ago, it seemed like there was, but there's not. So you do not have to rotate. A lot of times people will rotate partners every certain number of years to get a fresh set of eyes. But there are pros and cons to rotating. So.
Yeah.
All right. And if we didn't get to any questions or if you have more
Yeah.
follow-up questions, please feel free to reach out. We'd love to continue the conversation and, join our nonprofit community, come back for more webinars, more
Yeah.
roundtables.
Thank
So,
you, everybody, for participating. And
yeah,
great questions, everybody.
yeah. Thanks so much. Have a great rest of the day and stay on for the survey if you need CPE credit.
Yep.
Take care. Bye.
Thank you, everybody.